So looking at the markets, again, this is another 5-year chart. At the top of the chart on the the right-hand side, you've got the S&P 500, again, up over 95%. And at the very bottom of the same side of the chart, you've got 100% bonds, which is showing a negative 17%. You think about doing stock mixes to reduce the risk in the portfolio and stay diversified. Well, the more you put bonds in it, as you can see, the lower the returns were overall in the portfolios. Anybody who was at a 30% equities, 70% bonds over that whole time period, the 5 years, basically ended up with about a 5% rate of return. And then again, you go to the typical 60-40, and we are talking about just US markets, and the typical 60-40 is sitting at about 30%. So very different than a full equity market or portfolio if you were just in nothing but the S&P 500, which is really sitting at over 95%. So a big drag on the market when you're working with bonds. That's why it is so important to have some alternatives in your portfolio that are not correlated to the market or to the bonds. Now, moving forward, let's break down the bonds into different areas here. When you're looking at the left side of the chart, you're seeing the best returns really was on a global aggregate or global high yield index, which is representing bonds that are global bonds. And because of the additional risk premium that are given, you're seeing some real good performance in them. But you're also taking a much greater risk. You go all the way to the right side of the chart, where are we having real problems in the bond market? Well, it's muni bonds. The reality is with the high interest rates, it's putting great pressure on the muni bonds. And people are saying, why do I want to be in a bond that's not giving me the returns that even a treasury's giving me? So there is a lot of pressure on the muni market right now. Now let's go forward and let's take a look at the bond market from a bigger picture. Now this chart shows you a chart from 1980 to 2024. And on this chart, I'm going to point a couple things out. So this is the Bloomberg U.S. Aggregate Bond Fund, or bond index. And on the top, you've got a secular bull market, and you've also got a secular bear market highlighted in the green and the red. The secular bull market, when you think about it, the secular bull markets in a bond secular market tend to last over 30 years. And when you look at this bull market, you can really tell that the bonds were performing very well. Now, conversely, let's go to where we are today in a secular bear market. We are 11 years into this bear market right now. And if you just look at the returns, what we did on this chart is we put a red dotted line at the highest return, which is 9% for the bonds. And when you look over into the secular bull market, you can see, gosh, it almost looks like about half the time the bonds were over 9%. And keep in mind with this chart, what it shows you is with the blue bars, that tells you where the market ended up that year. The red dots kind of tell you where intra-year, where the bonds actually were at. So each year you see that the bonds go negative almost all the time. But the problem is in the secular bear market, we're just not seeing it come back like it does in a secular bull market. And that's why the bonds just are not performing like they used to. So we could be in the secular bear market for many years to come. We're just going to have to wait and see. But this is why you really need to be with a firm that is a tactical manager and has some alternatives to the bond market to allow you to still get returns when others in the market are struggling. This chart here is the same type representation, but what we're looking at is the equity market, the S&P 500. And what you probably already noticed is that the secular markets tend to be a lot shorter when it comes to equities. And they tend to run between 12 and 18 years. right now we're sitting in a secular bull market, and we've been here for, well, about 11 years. So in this secular bull market, we are still looking at some more running room. And if I was a betting man, I would say we probably still have another 4 to 5 years of this secular bull market as we're moving forward.